Interest rates represent the cost of borrowing money or the return earned from lending or investing funds. They are fundamental to financial markets because they influence investment decisions, economic growth, inflation, and asset valuations. Interest rates may be expressed in several forms, including nominal rates, real rates, fixed rates, floating rates, simple rates, and compounded rates. Nominal interest rates reflect stated borrowing costs without adjusting for inflation, while real interest rates account for changes in purchasing power. Fixed interest rates remain constant over the life of a loan or investment, whereas floating rates adjust periodically based on benchmark rates. The program emphasizes understanding different interest rate structures because they affect nearly all financial instruments and risk management activities. Compounding conventions and yield calculations are also important components of interest rate analysis. Simple interest calculates returns solely on the original principal, while compound interest generates returns on both principal and accumulated interest. Interest may be compounded annually, semi-annually, quarterly, monthly, or continuously, affecting the effective annual yield earned or paid. Yield measures such as yield to maturity, current yield, and discount yield are widely used in fixed income markets to evaluate investment returns. Central banks strongly influence interest rates through monetary policy decisions, including adjustments to policy rates and liquidity conditions. Changes in interest rates affect borrowing costs, consumer spending, corporate investment, and the valuation of bonds and other financial assets throughout the economy. Spot rates and forward rates are essential concepts in the term structure of interest rates. A spot rate is the yield on a zero-coupon bond for a specific maturity and represents the return earned from investing today until that maturity date. Spot rates form the foundation of yield curves, which display interest rates across different maturities. Forward rates represent implied future borrowing or lending rates derived from current spot rates. These rates reflect market expectations regarding future interest rate movements and inflation conditions. Forward rates are important for pricing financial instruments, valuing bonds, and managing interest rate risk because they provide information about anticipated future financing costs and investment returns. Forward rate agreements, FRAs, are over-the-counter derivative contracts that allow parties to lock in interest rates for future borrowing or lending periods. In an FRA, two counterparties agree on a fixed interest rate that will apply to a specified notional principal amount during a future time interval. At settlement, the difference between the agreed rate and the prevailing market rate is exchanged in cash. FRAs are widely used by banks, corporations, and financial institutions to hedge exposure to fluctuating short-term interest rates. Because FRAs are customized OTC contracts, they offer flexibility in terms of notional amounts and maturities but also expose participants to counterparty credit risk. Duration is one of the most important measures of interest rate risk in fixed income securities. It measures the sensitivity of a bond's price to changes in interest rates and is often interpreted as the weighted average time required to receive a bond's cash flows. Bonds with higher duration experience greater price changes when interest rates fluctuate. Duration depends on factors such as maturity, coupon rate, and yield level. Portfolio managers use duration to assess and manage interest rate exposure in bond portfolios. Duration-based hedging strategies are widely used to immunize portfolios against interest rate movements and stabilize investment performance under changing market conditions. Convexity complements duration by measuring the curvature in the relationship between bond prices and interest rates. While duration assumes a linear relationship between price changes and yield changes, convexity captures the fact that bond price movements become nonlinear as yields change significantly. Bonds with higher convexity generally experience smaller losses when interest rates rise and larger gains when rates fall compared to bonds with lower convexity. Incorporating convexity improves the accuracy of bond price estimates, particularly during periods of substantial interest rate volatility. Convexity is therefore an important risk management tool for evaluating fixed income securities and constructing portfolios that are more resilient to changing interest rate environments. The relationship between duration and convexity is critical for understanding bond portfolio behavior under varying interest rate scenarios. Duration provides a first-order approximation of price sensitivity, while convexity offers a second-order adjustment that refines estimates for larger yield movements. Portfolio managers often seek securities with favorable convexity characteristics because they provide asymmetric risk-return profiles. Duration and convexity analysis are also essential for interest rate hedging using futures, swaps, and other derivatives. Financial institutions use these measures extensively to evaluate asset-liability mismatches, manage capital exposures, and comply with regulatory risk management standards in fixed income and banking operations. The program highlights interest rates, forward rate agreements, duration, and convexity as fundamental concepts in financial risk management and fixed income analysis. Interest rate fluctuations affect bond valuations, derivative pricing, bank profitability, and macroeconomic conditions globally. Understanding spot rates, forward rates, and term structure relationships enables financial professionals to evaluate market expectations and implement effective hedging strategies. Duration and convexity provide critical tools for measuring and managing interest rate risk within investment portfolios and financial institutions. As global interest rate environments become increasingly volatile and interconnected, mastery of these concepts remains essential for risk professionals responsible for managing fixed income exposures and maintaining financial stability.